This last month, my investment portfolio hit a significant milestone. For the first time ever, the cumulative value of both my stock and crypto trading accounts passed $100,000. Now, for a lot of you, $100,000 might not represent that much money, but for me, it's a pretty significant milestone in what's been a 3.5-year journey of teaching myself how to invest and trade in different markets. Now, I started trading back in 2017, and since then, I've learned and applied a lot of different investment strategies and techniques. I've done day trading, momentum trading, I've looked into modern portfolio theory, but nothing really helped me create a conceptual framework like value investing. And when I look back on these 3.5 years, I can actually trace back to the exact moment that I went from an unprofitable to a profitable trader, and that coincides pretty perfectly with the time that I started looking into value investing. Now, what I'm going to do in this video is go over how I find deep value stocks. And deep value represents a smaller subset of my overall value investing strategy, but I thought it would be a good time to cover how to find deep value stocks, given the mania that we saw with a lot of deep value stocks like GameStop, BlackBerry, AMC in the market just a few weeks ago. While you shouldn't be buying deep value stocks with the expectation that that kind of mania is going to continue happening, finding deep value stocks is a consistently profitable strategy that I've been able to apply to slowly grow my investment account. So with that, let's get right into it. Now, the difference between deep value and I guess what you could call regular value investing is that deep value investing is a little bit more quantitatively based. Whereas regular value investing, you're looking for companies that are trading below their intrinsic value, but also have certain qualitative characteristics that make them a good investment if you were to hold them for 10, 20, 30, 40 years. And this is the style that Warren Buffett relied on a little bit more as he got older because he had more capital and he couldn't really play with deep value stocks anymore because they had very low market caps. And deep value investing follows a little bit more of a Benjamin Graham style where you're looking for companies that are severely depressed and trading significantly below their intrinsic value, and it's mostly a reversion to the mean kind of strategy, where you're going to be buying the stock when it's extremely undervalued and you're going to ride it back up to its intrinsic value, at which point you're going to sell the stock and move on to the next play. So to keep this video brief, because I just wanted to act as kind of an intro to people who are getting into deep value investing, I'm just going to briefly cover how I find deep value stocks, and then I'm going to talk about how I pick out the ones that I think are going to make the best investment. And then I'm going to cover just a couple short examples so you can see what it looks like in the real world. So there's two ways that I look for deep value stocks. The first is that I use a screener. And I've actually made a previous video on the screener criteria that I use, and I'll put a link to that video in the description below. And because I have that video, I'm not going to cover the screener criteria in this video, but if you're interested, you can go check out the screener that I use to find deep value stocks in that video. Now, the second way that I find deep value stocks is by looking for companies that have really bad narratives around them. And sometimes these stocks aren't going to pop up in the screener because maybe they don't meet a couple of the criteria that are needed for them to be included in that screener. For example, maybe the company is unprofitable or the market cap is too large or any other reason why it might not be included in the screener. So the screener is a good place to start, but it's not going to give you every single deep value play out there. Now, there's three main reasons why looking for companies with bad narratives is a good place to start. The first is that sometimes the bad narrative is overdone. And this happens because of something called loss aversion, where investors are a lot more sensitive to bad news than they are to good news. So investors tend to overreact on the downside, and this is a really good thing for value investors because it opens up a lot of opportunities if you know where to look. The second reason is that investment managers tend to overlook these companies that have bad narratives because if they were to make an investment in these companies, they're taking on a significant amount of career risk. If they invest a significant portion of the fund into one of these stocks with really bad narrative around them, they could end up getting fired. So a lot of investment managers overlook these stocks, which allows the market to undervalue them for a significant period of time and represents an opportunity for you, the solo investor. And the third reason is that sometimes the market overlooks something. For an example with GameStop, the market was overlooking the fact that a lot of console sales still happened in person and that there was still a significant portion of the market that were buying physical games. Now, if you're interested in learning more about the analysis that went behind GameStop, I've included a link to a video by Roaring Kitty in the description down below, and he was one of the first investors to hop on the GameStop train, and I think it's a perfect example of the kind of work that it takes to find these deep value stocks. Now, I also want to mention something that's probably pretty obvious in that a lot of the time, companies that have bad narratives surrounding them is completely justified. So while looking for companies with bad narrative is a good strategy, you want to be able to pick out the ones where you think that the narrative has been overdone. Now, there's a few ways that you can determine which ones you think are good. The first is by finding the intrinsic value of that company. Now, this not only provides you with an idea of what the return potential is on that play, but it also gives you an idea if the market is actually wrong about the value of that company. Now, if I find a deep value stock that's undervalued by only like 20 or 30%, then I just kind of toss those companies away because it's possible that I'm overlooking something. And also 20 to 30% undervalued doesn't really justify the risk that I'm taking by investing in a company that has a really bad narrative surrounding it. And that's actually something you should note as a value investor, in that you're being paid a value premium by taking on the risk by buying the stocks that nobody else wants to buy. When a lot of people think about value investing, they think of really safe stocks like Coca-Cola, but in reality, the reason why value investing has outperformed growth stocks in the long run is because of the fact that value investors are rewarded for taking on risk by purchasing stock in companies that other people don't want to be buying. Now, the second way that you can determine which of the value stocks make a good investment is by finding some sort of a catalyst. Some of the key catalysts you want to look for is new management coming in, a potential buyout, or maybe the company just signed a new major client. But essentially, you want to look for some sort of catalyst that is going to push the value of the company back up to its intrinsic value. Because if there is no catalyst, then the company can remain undervalued for a significant amount of time, and you're not going to make money for years. So you want to be looking for a catalyst that's coming up in the next year to 2 years. So now I'm just going to briefly go over 2 examples of deep value stocks that ended up working out really well for me. And the first is MAXR. MAXR is a space technology company that looked like it was going to be going to zero for a little while there. The company was losing money hand over fist, and the management clearly just wasn't very competent. Now, MAXR stock tanked from around $90 a share all the way down to around $5. And this was happening because, like I said, management was losing money hand over fist, and eventually the board of directors kicked that management team out and replaced it with a new one. And this is an example of a management turnaround that you want to look for in a lot of these companies with bad narratives around them. Usually if the company replaces old management with new management that's more competent, that's a potentially bullish sign for the future of the company. Now, I also wanted to watch what management was doing, and I saw that they were restructuring the debt of the company and starting to land pretty solid contracts that could pay off pretty significantly in the future. So the combination of these factors, in that management was restructuring debt and signing some pretty significant contracts, I decided to buy the stock in the $8 to $9 range back in summer of 2019, and I ended up selling it at around $25. So that was the first deep value investment that I made, and it worked out really well. And that's kind of what got me hooked on value investing. Now, the second deep value stock that I'm going to mention is Rocky Mountain Chocolate Factory. And I actually included them in a video that I made this past summer as one of the value investments that I was making. Now, Rocky Mountain Chocolate Factory was suffering pretty significantly from COVID because a lot of their retail traffic was coming from foot traffic in the locations of their stores. So retail sales dropped significantly, something like over 70% of their sales were gone because of COVID, and they had also lost their largest customer earlier that year. So there's a lot of really bad stuff happening to Rocky Mountain Chocolate Factory, but something that made me really bullish on them was the fact that they had signed an exclusive deal with Edible Arrangements. Now, Edible Arrangements has an excellent online presence, and the terms of the deal stated that Rocky Mountain Chocolate Factory would be their exclusive chocolate provider for the next 3 years, with the option to extend that deal up to 5 years. And on top of that, the founder of Edible Arrangements jumped onto the board of Rocky Mountain Chocolate Factory. So I thought that this partnership was a match made in heaven and would end up benefiting Rocky Mountain Chocolate Factory in the future. I started buying Rocky Mountain Chocolate Factory in the low 4s, high 3s, and in the summer it took a bit of a dip down into the low 3s and high 2s, but now finally the stock has jumped back up to around the $6 range, and I'm up over 50% in under 9 months. So that trade also ended up working out pretty well, and I think that there's a significant amount of upside to come with that trade. So those are 2 examples of deep value stocks that have worked out well for me in the past, and is an example of the kind of things you want to look for. You want to look for management restructuring the company, or bad management getting booted out and being replaced by good management, or you want to look for new deals being signed. And also both of these companies were very small cap companies at the time. Rocky Mountain Chocolate Factory I think had a market cap of 30 or 40 million when I bought them. So clearly the stock was overlooked because not many money managers really care to invest in a 30 or 40 million dollar company. So that does it for this video. I hope you guys found it useful. I hope that acted as a pretty good primer for anybody looking to get into deep value investing. And I look forward to seeing you all in my next video.